Hello everyone, this is Curtis Hawkins from AsiaPacifica.com. Okay, I'm going to be talking a little bit about investment approaches. A lot of people are wondering how to leverage up against bullion. Others are also wondering how to diversify within the mining industry. And others are wondering how to invest against inflation in other ways besides mining. So the first common question I get all the time is, should I buy on margin? Meaning, should I borrow money and invest it so I can make more of a return on bullion, buying physical bullion, like this? So I say no. You know, because margin buying on margin is so risky, and there's a correction in the bullion market, in the gold market, and you have to come up with a margin call. You're gonna have to sell at a loss, and eventually, because we are in a long-term bull run, eventually I believe, even though there's a quick correction which could last 3 weeks, maybe a month, it'll continue on its uptrend again. But if you have to settle a loss, that's not good. So how can you leverage up without borrowing money, but taking more risk, so you get more return for every dollar you put in? My strategy is investing in miners. Usually when silver or gold goes up about 1%, mining companies tend to go up at a 2-to-1 to 4-to-1 ratio. So a 1% move in silver means a 2% to 4% move in a mining company. So you're getting 2 to 4 times the amount of the move. So that's a good way to leverage up. Another way to diversify within the mining industry is investing in servicing companies. Just like the oil companies, they need to bring in third parties to evaluate mine shafts and to make sure they meet safety regulations and they're clean and they're producing the correct amount of silver. So servicing companies within the mining industry is a good way to divest within the bullion market. Because a lot of people have a lot of mining companies, but and I don't suggest putting 90% of your money into mining companies. So you're going to want to diversify within the industry. So spread out your risk. And then, in regards to investing against inflation, a good way to invest against inflation is to figure out what goods are highly imported into America, and you want to buy those goods. For example, seafood. 90% of seafood in America is imported. So if the dollar does decline rapidly or a lot over the next few months or a few years, that's going to cause the price of seafood to skyrocket, thus costing more dollars to buy the same piece of fish or same lobster. So the way you invest in these companies, or in this industry, is to invest in companies that fish or catch lobsters or crabs or whatever it is that you want to invest in, and buy those companies that do the fishing in that industry. Also, if you know of a good that is highly imported into America, and you can find out or figure out what is going to be substituted for that good, that's also a good approach for investment. So, for example, if steaks, we produce a lot of our own steaks, but let's say that we import a lot of our steak and our beef, and the price of beef goes up through the roof. That would mean that you and I, it's going to be a lot more expensive for us to buy steaks. So we're going to have to figure out, what are we going to substitute steaks with? In this hypothetical scenario, we could use beans. So if you think that beans are going to be substituting steaks, and that is a main staple in Americans' diets, then I suggest buying the beans in hopes for demand shifting from the steaks to the beans, thus causing the price of beans to increase. So those are three investment approaches you could um, think about. One, which is leveraging not with margin, but with mining companies, because you get the 2 to 1 to 4 to 1 ratio, depending on the size of the company. Two, investing in servicing companies to diversify within an industry. And three, figuring out what is highly imported into America and getting in those commodities, and also figuring out what goods could be substituted by Americans. Hope you enjoy. Bye bye.